For part 2 of chapter 2. We'll start out with looking at an overview of transactions for a company for their first year in business. And then following that, and this will allow us to kind of revisit some of the things that I talked about in part 1. And then we'll look at the financial statements and kind of move on to some other subjects in this chapter. So in this case here, across the top line of this transaction grid, they've got zeros all across. That's always the case with a brand new business. So the first transaction, they acquired $5,000 in cash from issuing common stock. So cash goes up and common stock goes up. Common stock is a category that we'll use very rarely, only when we issue stock initially. The next transaction, they provided $84,000 of consulting services, the key word here being on account, which means they're going to get paid later. So in that case, they increase accounts receivable, money they're going to receive from customers in the future, excuse me, and increase retained earnings as a result of that revenue. Revenues pull retained earnings up. Next, they collected $60,000 cash from those customers that they had billed. So in that case, we've got an asset exchange transaction where cash goes up and accounts receivable goes down. After receiving that cash, fewer people owe us money. That has no impact on retained earnings. We don't recognize revenue when we get paid, but when we provide the services. So next, we pay $10,000 for salary expense. So cash goes down by $10,000. Retained earnings goes by $10,000 because we're recognizing an expense. The same way with transaction 5, we pay $2,000 for advertising. Cash goes down, retained earnings goes down. And then we recognize $6,000 for accrued salary expense. So that means people worked for us and we owe them money and we need to recognize an expense, but we haven't written a check for payroll yet. So in that case, I increase salaries payable, a special kind of liability account just for pay for workers. I increase that liability and I reduce retained earnings because I'm recognizing that expense. Last transaction, they sign a contract for some future business. That's not an economic transaction. It didn't change the economic position of the company. So let's take a look now at the financial statements that would flow from this, because we've got everything we need here to be able to do the financial statements for the company. So the first one here, we have our income statement. Oh, excuse me. We have our income statement. That's the one that we'll do first. So I had consulting revenue, and then I had two different expenses, salary expense and advertising expense. That results in net income of $66,000. Remember, net income is revenue minus expenses. The next one here we have is a statement of changes in stockholders' equity. That's the one we do second. So in this case, they began the year with 0 common stock and they issued 5,000 worth. So that's where they end with common stock. The other category of stockholders' equity, retained earnings, they started with 0. They had $66,000 of net income. That boosts retained earnings. They had no dividends that they paid, so they ended at 66 for a total of 71. So I needed the net income from the income statement to be able to do the statement of changes in stockholders' equity. So that's why I had to do them in that order. And then I needed the stockholders' equity figures in order to do the balance sheet. So in this case, I have a balance sheet that's as of a particular day. It's not for a period of time. So I have cash and receivables, and they're in that order. That's order of liquidity. So cash is most liquid. So I've got $77,000 of total assets. I have that liability of salaries payable, and then I've got my two elements of stockholders' equity. So together, my liabilities and stockholders' equity equals $77,000, which equals my total assets. So the next thing I want to talk about are a little bit more about payables. So we talked about accounts payable. I showed you an example of salaries payable. Accounts payable is kind of the most routine liability account that you'll use during a business year. So it's all the kind of routine, paying the utility bill, buying supplies, buying inventory from suppliers, all of that. Another type of payable that's a bit more formal is a note payable. If you've ever bought a car and financed it, you've signed a note payable. So you've signed a note with the bank. So that's going to have terms, it's going to include interest, all of that. And I'm going to talk a little bit about how to calculate interest expense. So interest rates that are given to you are always quoted as an annual interest rate. Okay, so for example, in that first one there, we have $10,000 in principal. That's the amount we owe. The annual interest rate is 6%, which we would multiply by 0.06. We'd convert that to a decimal. And the term of the loan is going to be the number of months that it is outstanding divided by by 12. Always divided by 12 because the interest rate is for a year. So in this case, I'm only borrowing money for half a year. So to say 10,000 times 0.06 would give me $600 in interest expense. Well, that would only be relevant if I owed the money for the full year, and I don't. I only owe it for 6 months. That could either be the term of the loan or it could be the remaining period in that year. Like if I took the loan out on July 1st, I would have owed it for 6 months as of year end. So that's how I calculate interest expense. And the second one there, 15,000 times 0.1 times 3 over 12 is 375. So now we've got year 2 here, a bunch of transactions. So we'll just kind of quickly go through these. So we paid cash for the salaries that were accrued in year 1. So I had already recognized that payable. So now I'm just paying a payable. I'm not going to recognize the expense now in year 2. So cash goes down by 6,000 and salaries payable goes down by 6,000. Next, we acquired another 3,000 by issuing more common stock. So cash goes up, common stock goes up. We incurred a $4,000 utility expense on accounts. So here's where we'll use accounts payable. So accounts payable goes up and retained earnings goes down to recognize that expense. On February 1st, year 2, we borrowed $5,000 from Citibank. Let's assume that's a note payable. Okay, so $5,000 cash goes up and note payable goes up. Okay, so both sides of the equal sign increase. Next, we recognize $89,000 of revenue on account. So we did work for people. So because it's on account, accounts receivable goes up and retained earnings goes up. Then we collected $95,000 cash from customers in partial settlement of accounts receivable. So we received some of the money that was owed from last year and some of the money that we got for this year's receivable. So cash goes up by $95,000, receivables goes down by $95,000. Next, we paid $11,000 per salary expense. Cash goes down, retained earnings goes down. We paid a $10,000 cash dividend, so cash goes down, retained earnings goes down, and I note that it's a dividend, so I don't treat it like an expense. Then we adjusted the records to recognize $275 of interest expense occurred during year 2. So in that case, I'm accruing some interest. So I got a new category here, interest payable. So standing at the end of the year, I owe some interest on that note, and I need to recognize interest expense because I've owed the money for a period of time. So in this case here, I borrowed the money on February 1st, year 2. So how did they come up with that 275? Well, they multiplied 5,000 times, and I can figure out that it must have been, does it give us the interest rate? No, it must have been 6%. I could back into that interest rate. And they owed it for 11 out of 12 months. So that works out to 275. 5,000 times 0.06 times 11 over 12 is $275. Then lastly, they recorded $5,500 of accrued salary expense. So people have worked for me. I haven't paid them yet. So I increase my salaries payable and decrease my retained earnings. And then I add across the bottom to get my ending totals and see that both sides equal $143,500. So now I can do the financial statements for the second year. And in this case, I'm showing a comparative statement because that provides more information to users of financial statements. So in this case here, it's a little bit more complex. I have a few more items on my income statement, and I can see that my profit increased. My sales increased a little bit and my net income increased. Then I can do the statement of changes in stockholders' equity, and here you see the ending common stock of year 1 becomes the beginning common stock of year 2. Same thing with retained earnings. And then I can do my balance sheet. So here I can see that my assets increased and my liabilities increased a little bit and my stockholders' equity increased by quite a bit. So, and again, it's in balance, 143.5 on both sides of that. So the next thing I want want to talk about is how we can figure out a change in a balance. So if I know every account is going to have a beginning balance, it's going to have increases to it, decreases to it, and an ending balance. So it's always going to be beginning plus increases minus decreases equal ending. So in that case, if I know 3 of those things, I can back into the missing. So as an example, on that first one, say that I didn't know the decrease, say that that wasn't given to me. Well, I could say my beginning was 24,000 and I increased it by 89,000. So if I hadn't received any cash at all, 24,000 plus 89,000 is 113. So if I hadn't received any cash payments at all, I should have ended up at 113, but I ended up at 18. So that must mean that I received 95,000 in cash. So I can back into something that's missing. And that kind of just gives you a feel for kind of what's going in and out of accounts. The same thing with accounts payable, with money that we owe our suppliers. If I know the beginning, or even if I know the increase and decrease and I know the ending, I can back into what the beginning must have been. So that I'll post a separate video where I do a couple of examples of that that'll help you with your homework. So the last thing I'm going to talk about is corporate governance. So accountants are members of a professional society called the AICPA, and they issue a code of professional conduct that deals with internal controls, or deals with the behavior of CPAs. So independence, objectivity, being truthful, maintaining client information in confidence, all of those kinds of things. Sarbanes-Oxley Act is a federal law that was enacted after several very large bankruptcies, Enron, WorldCom, several very large publicly traded companies that went bankrupt. And it was determined that they went bankrupt because of improper accounting. And so there were rules created through this act to strengthen that system. Some of it is that CPAs, outside accountants that vouch for the financial records of a company, that they need to be more independent than they had been in the past so that their vouching has more weight to it. It requires that the CEO sign a statement saying that they understand the financial statements and believe them to be true. And the most important part is it requires a system of internal controls, which are rules within a company. And we'll talk about that more later this semester. But rules within a company to make sure that assets are safeguarded so fraud doesn't occur and people don't steal the company's assets, and that truthful records are produced from the accounting system. And again, we'll mention that later. So some common features of criminal and ethical misconduct, it's called the fraud triangle, is that there has to be an opportunity for fraud to occur. So maybe you have a box of cash in somebody's desk and it isn't locked up. Or people that work in the accounting system on their computers don't have passwords, so anybody can log in and do something in the accounting system that they don't have authority to do. So those would be examples of lax internal controls. We might have a situation where one person can issue a purchase order, receive physical goods, and authorize payment to the supplier. So obviously they could pay a fictional invoice for goods that haven't really even been delivered and benefit financially. So those would be examples of a lack of internal control. So that creates an opportunity. There could be pressure. So you could have personal financial pressure. Maybe your spouse lost their job and you're about to lose your house and you really need some money to catch up on your house payments. That would create financial pressure. You might have all kinds of, so there could be external financial pressure. There could also be internal pressure. Sometimes unethical conduct occurs because the company puts too much pressure on their employees to achieve results, and then they achieve those results through misconduct or through lying rather than through truthful behavior. And then the last is rationalization. The most common rationalization is, yeah, I stole from the company, but I'm underpaid, so it's only fair. or other people are doing it, so I didn't want to be the chump that didn't do it too. So there could be a variety of different kind of rationalizations that occur. The key thing here is that it's better to prevent fraud than to try to detect it after the fact, because people can always be very clever in how they manage to avoid detection. So that is the end of chapter 2. I'll post a separate video going over some of the sample problems that'll help you with your homework. So I will talk to you then. Thanks.